3, 2, 1.
All right. Here we are again, 19 May 2024. Fantastic.
It's years flying by, man.
Yep.
Put in the comment section if you think your year's flying by. Because I think our year's flying by. It was Christmas the other day.
The funny thing is, like, you know, people want to measure performance on like a year-over-year basis, right?
Yeah.
It's interesting looking back in hindsight, going, you know, from the beginning of the first year to the end of that year or whatever. But as it's ongoing, it's much different to try to get a sense of how the year is going to be as the year is ongoing.
As it's happening.
Yeah.
Oh, I know. It's always kind of hindsight's 20/20.
Yeah.
So it's easy to look at the charts and go, "Oh, you should have seen that coming."
Right. Like the companies that were killing it in 23 are.
They're not.
No, it's a completely different world in 24.
Yeah,
you know, even though the S&P is still going up, right? The market's
going up
still
for different
going up.
reasons.
Yeah, totally different reasons.
Yeah, definitely different reasons. But big congrats. Jerry's daughter graduated from Penn State this past week or so and commissioned in the Navy.
Yeah, she's going to be a submariner.
Absolutely.
Now she is a submariner.
I was going to say,
right?
I think she is.
Yeah.
Now it's the fact of she has to go through sub school, right?
Yeah, nuke power school in July, and then you call it SOBIC, I think. It's how to learn how to drive a submarine.
I want to learn how to drive a submarine.
That would be kind of cool, wouldn't it? Yeah.
Is that once you get your sub driver thing? Is that when you get your pin? Is that what that is?
Yeah.
Yeah, you get that big submarine pin.
Yeah.
That's the one thing that I remember about running into people when I was in uniform, and I would run into a Navy guy, and I don't know, they all look the same to me, right?
Yeah, kind of. Yeah.
I can't
it's
tell
hard to tell which is
aviation versus if it's
you
got
gotta look
wings
pretty close,
or water.
Wings or yeah.
And the nuke guys would always get pissy. They'd be like, "This is a submarine badge." I'm like, "Bro, I don't know. It's a boat in the water."
Right.
I'm sorry. I wish I knew.
The water wings. Yeah. Yeah, it's good stuff. I'm psyched for. So it's funny because my oldest is a aviation electrician. And so he got to do her first salute.
That is cool. And you caught a picture of it.
Yeah.
Which was awesome.
Yeah, it was cool.
Yeah.
Good weekend.
Did you find the silver dollar?
I got a silver dollar. Yeah, so I'm going to and I took it back for my son. I'm like, hey, I'm going to get one of these pictures and the dollar, put it in a frame, and basically get another silver dollar. So I'm going to do the same thing for both of them.
Oh, that's cool.
Yeah, so
cool.
Good stuff. All right, back to what we're doing here. We got a lot of interesting stuff to talk about this week. Actually, a lot of things happened this week. So, a lot of us follow Warren Buffett, and there was a really interesting video that I put out on Facebook earlier this week. And so we're going to kind of talk through that, and I'll put the link to the video. You guys can go back and watch it. PPI and CPI, the two big inflation reports, came out this week for April. One had inflation getting worse, one had inflation getting better, and we'll look at how the market responded to both of those. Kind of interesting. I got two bonus charts. Walmart, because Walmart earnings came out this week and gapped up 7%. But there's a downside to that. And in Dow Jones Industrial Average, I'm kind of stealing some analysis from my buddy Jim Bartoloni, a long-term trend of the Dow, which is a good thing to keep on your radar, and then a real quick run-through of the TSP charts. Okay. So we all follow, I don't want to say we all follow Warren Buffett, but he's kind of identified as one of the best investors of all time, right? And this YouTube, you can write it down, or I guess you're gonna have to write it down, screenshot or whatever. But it's a really good.
Can't click it.
You can't click it. Yeah.
Yeah.
But I put it up in the Facebook group. It's really, really interesting. It's this year's Berkshire Hathaway shareholder meeting, and what he's talking about, the big thing going on right now is how much cash he's I don't want to say hoarding, but he's sitting on. He's sitting on, and so when he sits on cash, it just means it's in short-term treasury bonds, which is they're returning roughly 5%, which is essentially like our G fund, right? So we're going to get to that. He is an institutional investor versus us, the retail investors, right? So when we can just move back and forth every day, or in our case, 2 moves a month, whatever. He cannot sell big chunks. He can't move his money around like we can. He's got to anticipate, try to forecast what's going to happen, and position himself. That's what institutions do. They do positioning. They're not responding to the market. So, and in his case, he's a value investor versus a growth investor. So he made his money, and it's changed over the years. And they talk about it in that video. But he's made his money by buying companies that are very undervalued. So the PE ratio is really, really low. You can't do that anymore. They don't have companies like that anymore.
Yeah, he's looking for a good deal.
Right.
Yeah.
And there aren't any good deals out there right now, which is why he has so much cash.
Right. Yeah. Yeah.
So another way of
there's not a lot of Johnson and Johnsons coming along, or big companies like that. At least not that I know of.
I mean, it can be any. Johnson & Johnson, a fine example.
Or Coke. Right?
Yeah,
There's not going to be some major company. I shouldn't say there's not going to be. Right now, like you're pointing out, there isn't any of these kind of companies that are coming to become a giant, like a Walmart, a Coke. Maybe there are. It's too early to tell, but they would really be replacing something, not brand new. Like there wasn't a Coke before there was a Coke, right? Coke and Pepsi, came up. Maybe like if there's a new industry, it's digital assets or AI. Maybe there's going to be a giant.
Yeah.
Right. But
there will be eventually.
But I can't think of a thing that would come along that doesn't exist already. So what I mean by this is like they would just replace the Coke or replace the whatever, because that's how he made his money, was buying those kind of things. Like
he did, but I don't know 100%, but I'd sort of argue that he would. I can't remember the quote from that video, but in 2008, he's giddy like to buy stuff, right? Because
everything's down.
Because everything's down. So he's buying Coke and Walmart and the big established companies that he knows are gonna come back,
weather
right?
the storm.
Yeah.
Right.
So he's looking at the bottom of the market. He's not looking at the market, but he's looking at the PE ratio and what he calls the Buffett indicator. He's got an indicator that shows whether or not the market is overbought, oversold, or somewhere in the middle. And right now, it's extremely overbought, right? Which is just another way of saying he doesn't see any value. He doesn't see anything that he can buy now that's likely to move up from here.
Right. It's all at the top.
Everything's at the top, which is why he's not buying new things, and the money that comes into Berkshire just goes into cash. So as of right now, right, March 31st of this year, he only has a handful of holdings. Actually, there's more than this, but these are definitely the top ones, right? American Express. Well, Apple is his biggest at 40%. Okay, so 40% of Berkshire Hathaway is Apple stock, and he's trimmed that down over the past couple of months. But Apple by far is the biggest. American Express, Bank of America. So it's only really a handful of companies, and if you do that math, that's 80%. So 80% of his equity holdings is only in a handful of companies. His total is $371 billion. Okay, so here's the handful that are of his equity portfolio. His total portfolio is $371 billion. Of that $371 billion, $189 billion is cash. Right? That's a little bit more than 50%. That's almost like saying he's 50C, 50G.
Yeah, we talked about that yesterday.
Okay. Essentially, that's what that's saying.
Yeah, he's in the G.
he's 50% G fund right now.
Yeah.
Now, that might blow some people's minds.
Yeah.
Okay?
It definitely will, especially for people that are always telling us, why would you go to G? If Warren Buffett goes to G, there's the same reason.
I mean,
cash is cash, and that's our version of cash. His version of cash is a little different, but it's the same principle as money market.
Right.
They're not in a stock fund for sure, right? And so if Warren Buffett can go 50-50, so can you.
Yeah. I mean,
but why is he doing that? Because he's protecting his money. He's protecting his money because he sees that that the market is an all-time high and is probably going to come down. That is exactly the same thing that we keep talking about on here.
Right.
We're not, the funny thing is in the financial industry, if you're paying attention, none of this is a surprise,
Yep.
right? And so a lot of times you guys think this is just our opinions. Trust me, it's across the board that although we're in the market right now,
Yep.
we also know that this is probably not sustainable, right? Same thing that Warren Buffett is
100%.
looking at. He's half in, half out because he sees, and then what happens is a value, investor like him is going to wait until it gets down.
It gets undervalued.
Until it's undervalued, then he's going to push
Yep.
all that cash back in
Yep.
there. And as it's rising back up, that is not really any different in principle than us sitting back in the G fund, waiting for the market to get back to what we would call a buy signal, meaning, all the indicators that we watch trigger. And that means, and for us, that means that the up has already started, right? So we're not catching the bottom.
Yep.
We're responding to, the trend has changed, and we're back into the C fund or S fund or I fund. It's the same principle.
Yep.
And so it's amazing to me, like, we always get these comments about, when someone quotes Warren Buffett, it's usually the quote about just put it in the S&P 500 and walk away. The reason he says that is he knows the people he's talking to when he says that are people he knows are passive investors who are not going to get educated on the market and are going to try to guess and game.
Right.
That's not the same thing. Right? He's not guessing what the market's going to do. He's responding to what the market is doing. The market is overvalued.
So he's not buying anymore.
He said, I'm going to pull them up and pulling some off the table, put it in cash. This is exactly the same stuff that we talk about all the time. And I think Warren Buffett gets misquoted more than anybody I've ever seen.
100%.
Because they just snip out a piece and they don't put context to it.
If you watch those, every year they have Becky Quick from CNBC that interviews him shortly after the shareholder meeting. Now they televise the shareholder meetings, which is amazing to me.
I know, right? It's pretty cool.
Yeah. When the last year's was really good. That was the last year. Charlie Munger died. His business partner died a few months ago. But the 2023 shareholder meeting was unbelievable, and they televised it, and they televised this past one too. But if you really want to know what he thinks, you should actually watch what he says, not the memes that fly across Instagram and Facebook, right? Anyway, watch that video. It's good. Okay, so what happens this week? We get the April PPI and CPI. So PPI is how much it costs producers to make things. So if the cost to produce stuff is going up, it's going to get, that cost gets pushed to the consumer. That's one way of measuring inflation. The other way is the consumer price index. That's actually what consumers pay for stuff, and whether or not that goes up or down. So PPI came out on Tuesday, and producer prices rise more than expected in April. Okay, so inflation was higher. It's okay. PPI rose in April. It's a sign that inflation is remaining sticky one day ahead of the highly anticipated CPI reading. Okay, so PPI comes out higher than expected. So Tuesday's stronger than expected PPI data is yet another inflation print that is taking longer to decelerate, which is why the Fed is likely to only cut interest rates once this year and likely towards the end of the year in an effort to give inflation more time to settle down. So PPI is saying that inflation is still hot and the Fed is not going to be able to cut rates anytime soon because inflation is still going up. That was on Tuesday. On Wednesday, CPI comes out, shows inflation is easing in April. Okay, so yesterday we got PPI saying inflation is getting hotter. The next day we get inflation is easing in April, with consumer prices still rising 3.4% from a year ago. So I'm going to get to that in a second. So inflation eased slightly in April, providing a bit of relief for consumers while still holding above levels that would suggest a rate cut is imminent. Markets react positively after CPI release, with futures tied to major stock indexes rallying, Treasury yields tumbling. Futures traders raised the implied probability that the Fed would start cutting rates in September. So if you remember the last here, the Fed's not going to be able to cut rates maybe only once and probably not until later in the year. The very next day, now the implied probability is they start cutting in September. If you're trying to trade based on what you think the Fed is going to do, I don't know how anybody's doing it. It's insanity. But what did the market actually do? All right, let me do this one first. This was PPI, right? So it comes out at 8:30 in the morning, and you would expect that if inflation is going up, Fed can't cut rates, the market should come down. But it didn't. It was up pretty good that day. And the next day, CPI comes out and says inflation is easing, and we have to be expected, a big pop in price, because if CPI comes out and says inflation's easing, then the Fed can start to cut rates. So that's what the market looked like on those 2 days. This is the reality of us for people that live in the real economy. Inflation peaked at 9% in 2022. Right, that was basically the bottom of the bear market in 2022. Since then, inflation came down, okay, but it basically hasn't moved. It's been consolidating, between 3 and 4%, since for a year, since May of last year. So when they get all excited and they're like, inflation's down, yeah, that most recent angle is down. But in the big scheme of things, supposedly the Fed needs inflation to get down here to its 2% target. It's got a long way to go on a percentage basis to get down to that 2% target. And it hasn't done with all the, higher for longer talk and everything else. It really hasn't moved in the past year. So it's going to be interesting going forward. But anyway, that's where we are right now. Okay, so Walmart. Walmart comes out with earnings on Thursday morning or Wednesday night, one of the two. It's the 25th biggest company on the S&P 500 by market cap. Okay, so of the 500 companies, Walmart's 25, right? It's not Apple, Nvidia, but it's up there at number 25. So what happened? 7% gap up after earnings, right? So it was a huge report for Walmart. If you guys remember, the whole S&P basically bottomed last December. We had this big run up through the first quarter. Walmart's one of those companies that has been consolidating over the past couple of months, right? We got this kind of smiley face here, and so it was primed to gap and start the next leg higher. Right, we were talking about gaps last week. This is a really, really good breakaway gap, right? We have this consolidation, breakaway gap, and it's very likely that Walmart keeps moving higher. That's great for Walmart. And a lot of people look at Walmart as an indication of how the economy is doing. So you might look at it and say, Walmart had great earnings and gaps up 7%. It's going to move higher. That's great for the economy, right? So this is the Wall Street Journal headline that comes out with it, and it's positive on the face of it, right? Walmart's sales surge as wealthier shoppers flock to retail, flock to the retailer. The problem is, wealthier shoppers are flocking to Walmart. The economy is bifurcated right now, right? There's basically people that make a ton of money and spend it and are keeping the economy afloat. And the bottom 50% that are getting crushed by inflation and layoffs are starting. So the wealthier, the idea that wealthier shoppers are flocking to Walmart, I think is a pretty good indication that the economy is in trouble.
Yeah, we talked about this before the podcast. You mentioned this, and I was talking about how I shop at Walmart a lot.
Yeah.
A lot of it has to do because it's just right down the street from me.
Yeah.
But we live in the richest county in America, in Loudoun County, Virginia, and Walmart is packed all the time.
Yep.
That doesn't mean everybody goes there is rich or whatever, but it's just an odd thing to me that the mall, which is probably 5 miles away with all the fancy, that place is dead.
Yeah.
And it's empty. And so I thought about it after we stopped talking and we started doing the podcast. I was like, well, it's not a good sign when the wealthy people are going to Walmart, But is it also just a change in people's buying habits? Meaning, like, like at Walmart now. When I was growing up, or not when I was growing up, 'cause I don't remember Walmart then, but I lived in Arkansas. I lived in Walmart heaven,
Yep.
Arkansas,
Yep.
for 10 years, and yeah, you knew when somebody was wearing Walmart clothes because they didn't have brand names. They had like the cheapest stuff, right? Now you go into Walmart, it's still cheaper stuff, but it's Reebok, it's Nike.
Yeah.
They have some brand names in there.
Right.
You can't go buy Nike shoes, I don't think, but clothing wise, the area's getting a little grayer. So is it the shoppers are just like, I'm not going to go pay $80, for this for maybe for kids, right? I'm not going to go. I don't know. I was trying to think, like, are there other reasons why wealthy shoppers are going there? But I think it's mostly what you're speaking to, which is, they're going there because the economy's down, and okay, I'm not going to go buy stuff from Neiman Marcus or where I don't even know where people shop anymore.
Yeah.
Macy's. I mean, the Macy's around us closed. There is no Macy's
Yeah.
anymore. Like they used it as a COVID shot
Yeah, that's
place
right.
or
That's right.
whatever. This massive place at the mall. I took my daughter to the mall a couple weeks ago, and it's just barren. They're turning it into multi-use stuff, and
Yeah.
I don't even know. Like, malls are gone.
Yeah. Yeah. That's another whole conversation.
Yeah.
Commercial real estate is one of the next shoes to drop, but people have been talking about it for a while. The other interesting thing on this is customers prioritize staples over discretionary purchases. So I'm pretty sure it was last week we were talking about XLP, which is consumer staples, versus XLY, which is consumer discretionary. When staples is outperforming discretionary, if you put that on a chart and over time of the S&P 500, when utilities and staples are are outperforming tech and discretionary, the market's getting ready to roll over. So there's a lot of good information in this one little picture here, and none of it's good, even though you got a monster 7% gap in Walmart, So it's great for Walmart, the company, for now, for a while. But in the big scheme of things, it's not good.
It's not a good economic indicator.
Yes, right.
When rich people are flocking to Walmart.
Yeah, especially since they're buying more staples versus high end stuff. Even if you're at Walmart, you can still buy computers and TVs and all that, but they're not even buying that. They're buying, like you said, clothes and food and stuff.
Groceries and food. Yeah.
Okay, this is a pretty interesting one. So Dow Jones Industrial Average, again, it's not our S fund. It's the Dow Jones Industrial Average is big. It's 30 of the biggest industrial companies in the United States. So this goes back to about the late 1800s. Okay. So here's the top in 1929. And here's the bottom of the Great Depression in 1932. And so if you connect the major tops, right, you get a couple of little overshoots here and there, but you connect the major tops, and we are right back to it right now. Every time price has gotten back to that trend line, it's rolled over. Doesn't mean it can't get up here, come back, test it as resistance, and keep moving higher. Right? That's a possibility. It's just that over the past 200 years, however long that is, it's never been able to get above that trend line. So something to consider. These are obviously very long-term charts, and we've been banging up against that line here for the past 10 years, but it's not able to get above it. So it's something to keep in mind. And the channel. This is the bottom channel. Bottom of the channel is the top of the channel. At some point, we're going to get back down to the bottom of this channel and hopefully not break below it. But at some point, over some amount of time, we're going to get back to the bottom of that channel. So if we zoom in a little bit, this is what it kind of looks like right now, right? This was the top channel line. This was the bottom channel line. And I put this trend line in there as the most recent. So it's still monthly, right? Each of these ticks is 1 month of price movement. So if we connected the primary lows back here since the bottom in 2009, we got a little bit of an overshoot in COVID, but basically every time we hit the bottom, we got support and moved higher. Couldn't get above that upper channel here. We're approaching it right now. And in the big scheme of things, we're in this ascending triangle pattern. So it might still take a few years, right? But at some point, this thing is going to break. It either breaks up or it breaks down. Seemingly, it would break down and get us at some point back to this lower channel line. And that is on a percentage move, it's a huge one. It's not something that people really want to contemplate, but the reality is that's what the thing has looked like over hundreds of years. Does it have to continue? It doesn't have to, but it's, once the thing is set in motion, it tends to stay in motion. So take it for what it's worth. All right, quick run through. Somebody had asked in Facebook, because we pretty much only do the C fund charts lately. The idea there is that the subscribers to the site get a lot more detail in all the charts in the newsletter.
Yeah, I mean, when we first started this thing, the podcast, we were given out quite a bit.
Yeah.
we were given pretty deep rundowns of each and every fund.
Yep.
And that's not really fair to our subscribers. And honestly, we didn't really have a plan, right? This thing has evolved over. I mean, we're on year like 3 or something. Yeah. I don't even know how many podcasts we've done. Do it every week. Yeah, so that's really kind of where that came from. With a lot of the members were like, hey, this is what we're paying for,
right,
and so
and it's fair.
Yeah, it is fair, and we don't charge much, it's like a cup of coffee. The thing is, even what we do here, our analysis each week in our newsletter on our site, Jerry walks through it through a video, and also does a written form, depending on how you like to get your information. But it goes deep, and it also gives you more perspective on how you might need to change your plan for the upcoming week and that sort of thing. Because that's really what we strive to do, is help people build their plan to manage the TSP. We're not trying to tell you what to do with your money. Right. We have no idea what's going on in your life. We don't know your personal circumstances. We don't know your risk tolerance. We don't know anything about you. So a lot of people take this stuff as financial advice, and it absolutely is not. What we're trying to do is get you to at least take a proactive role, right, and manage your account versus, because we know what the higher percentage of people, that come to us are like, oh man, I've been in the G fund for 6, 8, 10 years, right, or in the N fund, or just something that they did when they first joined, and they're still there. And we're like, okay, no worries. Start now. Start managing now. Don't worry about what you did for the last 10 years or 5 years. Make a plan.
You have to. It's like anything else in your life. You have to make a plan and focus on what you're doing, and then adjust the plan, as you go along.
Exactly. You either fail to plan or plan to fail. All right, back to the charts.
Okay, so we're going to do a real quick high level of all four of them. So weekly chart of the C fund. Here's the bottom back in COVID. This is the 20-week moving average line. So every time, once we got back above that line after COVID, every time we came down to that 20-week, we got support there, right? Until it broke in a very obvious way in January of 2022. So even if you were just following on a weekly basis, you would have stayed in the stock funds, in this case the C fund, until we had this very clear break of that trend. Now, if you got out of the stock funds the next week, so this is a weekly chart, so on Friday afternoon that week the market closed there. If you said, okay, I see that this trend has changed, you would get out, right? You would reallocate out there because the trend changed. Yes, you're going to take this drawdown. Let's call it a loss. You're going to take this loss, but you got this whole gain, and you protected yourself against that decline. So that's the idea. All right. So we were talking about this a while ago. This is the first test of that 20-week since all this churning off the bottom, right? This was a tough one last summer. because the 20-week is right through the middle of that correction. But several weeks ago, we were talking about we didn't get below that 20-week moving average line that week, and that was the bottom of this little correction we had in April, and the market kept moving higher. So we're now at new all-time highs. It would have been, honestly, it would have been better, I think, if we had pulled back to 480 on the SPY, just because it would have been a more solid resistance level, or support level rather, and it would have set us up better for gains going forward. But we didn't get that. So at any rate, we're now at, again, new all-time highs, and no reason in this chart to think that the market doesn't continue higher, at least in the short term. S fund, nowhere near its prior all-time high, right? On a percentage basis, it's still 10 or 15% below where it was. After the bottom in October 2023, it moved up a little bit. It's not looking as strong as the C fund. The small cap companies are definitely not in a position that's as good as the mega caps on the S&P 500, but that's where we are in the S fund. I fund, as the dollar goes down, the I fund goes up. So watching the dollar is pretty critical. I fund hit 82 3 times back there in 2021 and couldn't get above it. And we are right at it again right now. So it'll be very interesting to see if 82 acts as resistance, or can we get above it, come back and retest it, acts as support, and then the I fund keeps going. The U.S. economy is not doing great, but it's doing better than pretty much everybody else. So it'll be interesting to see what happens here. And again, it's all based on the dollar. If the dollar's going down, the I fund's going up. F fund, I still think, is the most important chart. I talk about this all the time, but this was the top of a bull market in bonds that has been going on since 1982. So when rates are high, the price of bonds is low. And so interest rates were like 20% in 1982, and ever since then, rates have been coming down, which means the price of bonds has been going up, right? Until 2020, when rates got down to like 0.5%, and the Fed started raising rates. So when the Fed starts raising rates and the longer term rates keep going up, the price of the bonds goes down. So price has come down in 1, 2, 3, 4, 5. This perfect Elliott wave pattern. We had a first move off that bottom, a correction, and now we're in. This is going to be really interesting to see. The F fund is going to keep going higher. It either goes A, B, C, and then rolls over and starts going down again for another leg, or it's a 1, 2, 3, 4, 5. Either way, the next move in the F fund is up to some point. It's a very easy trade. And the risk right now is very low, because if you were to buy the F fund here and it rolled over and got below here, you would sell it, because clearly this downtrend had not completed yet. So the expectation is it goes higher from here. So if you buy the F fund here, this is your line in the sand. This is your defined risk for this potential upside. That's the best way that you can, if you can make reallocation decisions that has a quantifiable downside risk, that's kind of the best way to play the game. Okay, so if you guys want more in-depth, again, the newsletter goes super deep into all this stuff, and actually quite a bit of other things that we don't do on the podcast. But definitely sign up at growmytsp.com.
And if you have, let's turn my mic on. And if you have questions, you can always put them in the comment section wherever you found the video. And if you don't have a comment section for some reason, you can send us an email. That's to support@growmytsp.com. Appreciate you guys watching every week. We love doing this show, and we love getting the comments, so keep them coming. If you have a comment, it helps us figure out what people's questions are, or comment or question. And, it helps us. If you've got a question, that means there's probably a couple hundred people out there, or a couple thousand that have the same question. So it's always helpful. If you like the show, share it with your friends.
All right.
All right.
Have
we'll
a great
talk
week.
to you guys later, and we are
Out of here.
out.